The electric vehicle revolution is built on a hidden dependency. While the world focuses on sleek car designs and battery ranges, the real power play is happening far from the assembly line. It is happening in the humid mines and red soil smelters of Indonesia. This isn't just a story about a mineral, it is about how a single developing nation has fundamentally rewired the global supply chain for the world's most critical resource. Welcome back to the Macro Map. In the race to go green, we're discovering that energy security is no longer just about oil wells, but about who controls the earth beneath our feet. Indonesia has weaponized its nickel, and the entire automotive industry is now forced to play by its rules. This is the story of the nickel grip. For decades, Indonesia operated on what analysts called a colonial supermarket economic model. It exported vast quantities of raw nickel ore, only to see that wealth processed and captured by high-value industries elsewhere. Indonesia received the crumbs, while the world took the cake. The strategic pivot came in 2020, with a move that was as simple as it was audacious: a total ban on the export of raw nickel ore. This wasn't merely a trade policy, it was an economic declaration of independence. The mandate was clear. If foreign giants wanted Indonesian nickel, they would have to build the smelters and refineries on Indonesian soil. Overnight, a domestic industry was forced into existence. The international response was swift and hostile. The European Union challenged the ban at the World Trade Organization, calling it an illegal restriction on free trade. But Indonesia did something remarkable. It defied the ruling. Jakarta calculated that the penalties of the WTO were merely a cost of doing business, a small price to pay for the long-term sovereignty of its industrial base. This defiance sent a chilling signal to the West. Indonesia was willing to break the established rules to secure its own future. The ban's mechanism was brutally effective. It created a wall around the world's largest nickel reserves. On one side were the automotive giants who desperately needed the metal. On the other side was the nickel. The only way through that wall was a multi-billion-dollar investment in Indonesian infrastructure. This triggered a massive, forced capital migration. Chinese companies, seeing the strategic void left by the West, became the primary partners. They poured billions into sprawling industrial complexes, while Western firms, hesitant and cautious, were left watching from the sidelines. The impact was seismic. Overnight, a massive portion of the world's nickel was pulled off the open market. It was now tethered to Indonesia's new industrial heartland. This gave Jakarta unprecedented pricing power and control over the flow of the Green Revolution. The balance of power had shifted from those who buy to those who own. But this rapid expansion comes with a significant environmental bill. The nickel Indonesia possesses is laterite ore, which requires a process known as high-pressure acid leach, or HPAL. This is not a clean technology. These plants are energy-intensive and generate toxic waste, known as tailings, that can poison the surrounding ecosystem. The carbon footprint of Indonesian nickel is considerably higher than its counterparts in Canada or Australia. And so, the world faces a dark paradox. The very batteries that power our clean, silent vehicles are dependent on a production process with a heavy environmental cost. Beyond carbon, there are serious questions about deforestation and labour standards. The rapid construction of these zones has raised concerns about water pollution and the displacement of local communities. For Western automakers who brand themselves on ethics and sustainability, this is a profound dilemma. They are caught between two competing pressures: the urgent need to secure nickel for their survival, and the reputational risk of being linked to a contentious supply chain. This has become a strategic trap. Automakers can either source from Indonesia and face a potential backlash, or source from more expensive, lower-impact producers and risk being priced out of the market. Meanwhile, Chinese firms, unburdened by these ESG expectations, have secured their supply lines and gained a massive cost advantage. It is a dynamic that puts Western manufacturers in a permanently defensive and vulnerable position. What we are witnessing is the birth of a new form of economic cartel. It has parallels to OPEC's dominance over oil in the 20th century. But this is a 21st century model. It is a single, resource-rich nation using its sovereign leverage to dictate terms to the world's most advanced industries. Indonesia's partnership with China has created an axis of manufacturing might that is difficult to challenge. Western nations, through policies like the US Inflation Reduction Act, are trying to build alternative supply chains. But the math is challenging. The sheer scale and low cost of Indonesia's production are hard to beat. Indonesia has created a blueprint, and other nations rich in lithium, cobalt, and copper are watching closely. They realise that their resources are no longer just commodities. They are levers of global influence. For Western policymakers, the response cannot simply be protectionism. It requires a nuanced strategy, combining investment in recycling, support for new mining standards, and deeper diplomatic engagement. The definition of energy security has been rewritten. It now encompasses resilient and ethically sound mineral supply chains. The realignment of global power is underway, and it starts with who controls the ground beneath our feet. If you want to understand where the global economy is heading, keep mapping it with us. This is the Macro Map, understanding the economy behind the headlines.